What's up, everybody? Michael Silva here. Wow, we got a nice little stock market bounce, and I got a good stock market brief episode up ahead talking about seasonality, what it suggests for the rest of the year to look like. Now, that bounce came on some news out of Europe. What's going on now? Are they already getting scared here? I don't know how to interpret this yet, but the U.S. markets thought this was great news. Bank of England intervenes to avert a credit crunch. That came out. If you take a look at ES, bam, as soon as the news hit, we ripped up basically throughout the remainder of the day. Even the bond market or the note market, looking at ZN over here, you can see when it came off, we saw some massive volume take off. That was even pre-market, and we saw some huge volume, and then the rally continued on, taking everything up for the day, right? All 11 sectors were up in the green, right? And then we had the Dow that rose 548 points. The NASDAQ was up 2%, and then we had small caps, went the most, almost 3% on the day. Now, we did not need this news to understand that it was time to see a market bounce. We just needed the trigger. And what do I mean? Well, we were looking at the zones prior, and we noticed that, hey, guess what? There was minimal downside, and there was a lot of upside. This was for going into today's trading sessions, which were pulled the day prior on 9/27. And then now just look at this move coming in for tomorrow's zones. You have now from 2.3% downside now to minus 4%. We had 9% upside to around 7%. So now, what went from a great risk to reward all of a sudden now mitigated to sell for almost a 1-for-1, where the S&P 500 closed at 3719. Okay, and that is just slightly below the middle of these zones at 3768. You can look at the VIX. The VIX lower range right here is at 2351. It's actually up a little bit higher from the prior trading day, and then the high is at 3392 the prior day, and then coming into tomorrow, it's a little bit higher too as well, 34. So not that positive, right? So we got to have our reservations here on the rally. Same thing goes with the 10-year yield, right? We had 14% downside to 1% upside. Look at today. It's almost 1-for-1, right? So it's right there where? At the middle of the range. It closed at 3705, and now it's slightly below the middle of the range, 3706. Okay, so we're just seeing some just amazing moves overall in the market that we had to prepare for, and that's exactly what we did, right? We said, this is not where you want to press shorts, right? And if you're 100% short, you might want to consider changing up your strategy a little bit. Even the dollar, right? It had 0.64% upside going into today's trading session, and now it has 2.14% upside. So obviously a big difference right there too as well. Also to note, we talked about the UUP reaching up to its upper weekly risk range. So what happened? Or what weekly expected move? It came off a little bit, right? And then HYG, it was coming into its lower weekly expected move based off of implied volatility, and it bounced up a little bit. We talked about growth to value, that we saw that big rate of change pop. Now we saw the market react to it. We had the beta rotation tool that Michael Gaia talks about, right? We discussed that it was crossing down through zero. That means the rate of change between utilities and SPY, right? SPY was going to be performing. This is more of a risk on type of interaction. We had the buy signal go and activate on Bitcoin, and this is still, I still have my reserves, but hey, we saw the pop today. We talked about overextended areas as far as breadth measures go. The S&P 500% of stocks above the 50-day and the 200-day, which are still, they're pretty overextended to the downside right there, if I do say so myself. We talked about all these BP charts being overextended as well, and we're starting to see that bounce. We talked about the Nyse-McClellan oscillator, and now we're starting to see it uptick a little bit here, getting outside of these really overextended readings, albeit the summation index is still pointing at this current moment straight down. We even introduced this one yesterday, which I learned from Brian Chapman. We talked about how when these go over, this is volatility, right? We're looking at back month to front month, and then we have the orange is the VIX in the background. When it crosses down through here while the VIX is up here, sometimes it marks short-term bottoms. And yeah, so we saw the market rally, and the market would have rallied a lot more if it wasn't for this one right here. Apple was down 1.26%, so the only red thing really in a sea of green here, and that was based off of production increase, ditches iPhone production increase after demand falters. That news right there, but it really didn't hold Apple down all too much. It was down more in the pre-market. Now it was only closed 1.26%. Now, we need to have our reserves still, right? We need to be still cautious. Yes, we can see a bounce, but the reality is the volatility futures are still within backwardations, which say what? It means that we have more risk right now than we do currently looking out to the future as it stands, right? So this is in backwardation. Typically what you see as a normal curve, you would see something like let me just draw it out. So here, and here, right? So it'd be contango. We'll talk about that in other episodes. And then also just look at the VIX levels, right? They closed at in the 30s. Okay, so it's still very, very elevated as it stands right now, which means we can see, plus 2% swings potentially still in around this range. If you want to know that, you can just divide this by 16. That should give you an approximate estimate of a percentage basis type move. VXN 35.51 it closed at. We have RVX. Yeah, these are coming off, but look at these numbers. It's still in the mid 30s. So we need to have our reservations. Do not just get all willy-nilly and start just jumping in and chasing stocks. You need to still be very risk focused in this current environment. If we take a look at the 15-minute time frame, SPY got above the 5-day moving average, so that is a good sign so far. The 5-day moving average is still declining at this current moment. We have a gap right above us. We're going to hop into the anchored VWAPs, which, by the way, we did discuss the positive divergences as well, right? So as price was heading lower, right, momentum was telling us that the downwards pressure was weakening, and it played out to the upside as well. So these were all hints, notes as to what we can potentially expect for price action, okay? That is how we prepare for this stuff. Now, if we take a look at the anchored VWAPs, the price did get and close pretty much on the FOMC anchored VWAP, which is the white one. The blue one is the CPI release, which we have not back tested. The last back test was over here, and it held as resistance. And we're pretty much, take a look where we are. Look at the weekly expected move. So 380.44, 355. We're basically right there in the center of the weekly expected move. And we're talking what, we've had some chop. We have 2 more trading days left. We've been seeing it hit, right? We've been seeing it hit the weekly expected move, and even having 2 sigma moves, 2 standard deviation moves every week here for the last 6 to 8 weeks. We've been seeing it break it or hit it. And we have 2 trading days left, so be on guard, right? Volatility is still high. The probabilities of hitting this are very high, and that's plus or minus, right? You can't handicap really risk right now, given the trend and where we are. It suggests down, but today's price action suggests up. So you got to be careful here. What can we potentially look for tomorrow? If you don't want to chase a move like this, potentially look for a pullback into this anchored VWAP that I lowered here to the low of the day, and then back to the 5-day moving average. So if we get something that looks like this, boom, comes down, maybe undercuts, and then moves up like that, or it gives us an opportunity for a stop here or a stop there. So it's basically just back testing these two, the 5-day moving average, which would kind of try to flatten out here. This anchored VWAP would pick up. And if you want to play to the bullish perspective up to there, that would be a great trade in my opinion. So that is something that I'll watch out for. Now, if we just get some crazy gap up, be cautious, right? Because yeah, it can run right up and we can get a continued squeeze. But you just got to be cautious chasing those type of things. So if we do get some sort of a gap up, maybe potentially look for a backfill, something like that, and then enter in to see if we get some continuation. There's going to be multiple ways to play it. You just got to be on guard, and as new data comes out, then we'll play it like that. If you take a look at the Qs, trading above that 5-day moving average, positive divergence played out. We have a little gap above us. If we take a look at the anchored VWAPs, you can see here, I had this anchored from a couple of days ago on this gap up, and this actually lined up with the bottom here. So I applied that anchored VWAP. I'll be removing that one, and you can see here, this was actually a trade that I took. So I'll walk you through my trade, and I shared this one intraday with my Patreon group, which is something I don't really post my intraday trades because I'm just a little bit too focused, and it's hard for me to do multiple things. So I prefer swing trading, but in high volatile environments, I move from swing trading more over to intraday trading because it just works better for me. Now, I played this candle, this specific candle. I was watching for the break. This candle whipsawed me out. So it started breaking out, and I was like, okay, cool, I'll get in. Then it completely reversed, and we saw a hit below basically this candle. I was like, I'm going to keep my risk tight. And then it triggered right beneath it right there. So I got stopped out for about a 9-cent loss or something like that as far as my positioning was per share or something like that. And I was trading, I think it was the TQQQs at the time. And then what happened was I just basically said, I'm going to wait to see, and I'll re-enter if we start getting above it. And well, we started getting a little bit back above it, but I entered in a little bit lower on this candle, right? So we were coming in, we opened up here, we started moving up, moving down a little bit, and I said, you know what, I'll take a stab here a little bit lower, and then I'll just have a stop under my shakeout candle right there, that this big kind of like this high wave type of candle right there. So I entered in, had a stop, and then that's when the thing took off. Updated my stop as time goes, took profits, and played it multiple times throughout the day. I even played it back up through the FOMC VWAP later on in the trading session for a pop up. One of the things that I had mentioned was on squeeze days or short covering rallies, it's very typical to see the market close at about the high of the day. So the candle looks kind of like this on the daily. We did have a little bit of a shakeout there towards the end, so we'll see what happens. Going into tomorrow, I'm going to be looking at these VWAPs, right? So as we're trading above it, you want the 5-day moving average to start flattening out, right? And you want these VWAPs to start coming in. And you want to see price potentially come down into this area, and then, something very similar. Set something up where you can have nice stops and good risk management. You don't want to just play it if it comes straight down like this and you enter in blindly with where'd your stop go? Right down here? That's a pretty big move. So what you want to see is, maybe, comes down, and then maybe you pick it back up through that area, and then you have a stop, something like that, and then you play it up. All right, that would give you a better risk to reward, in my opinion. So that's what I'll look for. IWM broke out of that wedge above that 5-day moving average there too as well. Not too far off the weekly expected move, as it had one of the stronger trading days of the session. You can see the low anchored VWAP down here is coming into that 5-day moving average. It's above the FOMC VWAP. You want to start seeing this 5-day moving average curl back up, and you want to see this hold, so it goes something like that. It starts breaking up like that. We could get, like I said, we can be getting the gap up and go, but from a risk to reward standpoint, after a strong move, you want to be cautious, you want to be careful, and play, with your risk tight. Now, in the early beginning of the episode, we talked about seasonality, what it suggests for the rest of the year. So let's just draw out what that would look like. I posted this on Twitter, and you can't. The whole point of this is, people want to handicap what the market's going to do for the next 3 months and just say, this is what's going to happen. First and foremost, you can't do that. So the reason why I'm showing you this is because, 1, it looks crazy. 2, it can play out, right? But 3, this is just based off of seasonality to maybe lay forth, what could potentially happen. And let me tell you, if this or something like this were to happen, this is a lot of chop, and this will throw people, all types of ways. Right now, as it stands, I feel like people are just saying the bottom's in, so it's either going to go up all to new highs, or we're going to, crash to all-time lows. It's like there's nothing in between. So I wanted to just point out, take a look here. I'm tracking this one right here, second year Dem president. It's the red, right? So 2022 started, right? 2022 started. It started going down. We saw a nice rally there, March, April, May. If I go back over here, right? March, April, May, well, basically it kind of rallied ahead of time. But yeah, in the March area, we started getting that big rally. And then take a look over here. It started doing this. The most important part that I noticed was it kind of did this head and shoulders pattern right here. And then it hit a bottom in June and retested the bottom in September. Well, take a look here. It hit a bottom in June, did that head and shoulders type pattern, right? Boom, boom, boom. And then it retested it here at around the same time in September, in the end of September. So all I'm doing is just mimicking what this has looked like to maybe give us a guide, right? So typically October can be a crash month. So if we do get some sort of, rally, boom, and then we get a very big flush, it seems like in November, going into November. And then then November, it's kind of like a flat month. And then December, we get these, end of year markups, potential rallies. So that's all that I did here, drawing it out, saying, okay, can you make trading decisions based off of this? No, we get more data as the time progresses. However, hey, if this is a possibility, we might as well just kind of consider it and think about it and be aware of the stronger pivots. The stronger pivot being, hey, we could potentially see, which we could be at the early stages, a rally into October, and then a potential big flush in the middle. So the main points to watch out for is a potential rally into November, and then a flush a rally in the middle, into the middle of October, and then a flush into very early November to late October. So those are a couple of things to potentially watch out for. Where can the rally go? Well, I just marked it to 390, right? 390 has been a very key level. If I drew it in more areas, if I had more data to show you going back further, you would notice also how just important 390 level actually is. So it's not a prediction by any means. All I'm doing is just copying seasonality to maybe give us a guiding, idea of key pivot points. And those key pivot points, once again, I'll remind you, into a rally potentially into the middle of October, which would be a key level, and then a potential flush into the early stages of November. That's all I got for you, everybody, on today's stock market brief. Hope it helped out. See y'all.